If you haven't heard of infinite banking, you must be living under a rock because it's everywhere. The hottest topic today when it comes to making money is infinite banking. Everybody is asking, what is it? How do you do it? And can I do it too? And today we are going to explain exactly how that works. So whether you are an agent looking to better understand the concept of infinite banking so you can help your clients out with it, or you are somebody looking to potentially own an infinite banking policy for yourself, this video will literally share with you everything you need to know about how to properly design and structure your policy for it to be an infinite bank. My name is Amanda Ryba. I have been a licensed financial professional for the past 8 years of the date this video is being produced, and it is my goal to illuminate to the world what wealthy people know and understand about money. And one thing the wealthy elite have been taking advantage of for decades is leveraging and earning interest in two places at one time, and the infinite banking strategy is one of the strategies they are using to do it. So let's dive in. The concept of infinite banking was introduced into the industry in the 1980s by a gentleman named Nelson Nash, who back then was using whole life policies to do infinite banking. Well, since then, there has been a lot of evolution in the financial services industry, and today we have a product on the market called Index Universal Life. I'm not necessarily going to say that one is better than the other, but if the goal is to grow cash value, Index Universal Life has the chance to earn higher interest because your cash value is growing against a stock market index instead of growing at a fixed rate, like you will see with a whole life policy. Now, I'm not going to dive into any of that in this video. If you have no clue what I'm talking about, just pause this video, check out the links below that will explain to you more about what an IUL is exactly and exactly what infinite banking is and the whole concept behind it. Today, we're actually going to show you how we do it with an IUL policy. Whole life, again, it's been around for a very long time. Think iPhone 1. But as I mentioned before, evolution has taken place not just in technology, but also in financial products. So today, the IUL is the latest and greatest product on the market today for concepts like infinite banking. Think of it like the iPhone 15. So let's dive into how we actually do this. Here is a real life example of a male that is 35 years old, based out of California, that wants to design his IUL policy for infinite banking. So what is important to know is with an infinite banking policy, you want your client to be max funding their policy as quickly as possible because that's going to give them access to the most amount of money in the first 1, 2, or 3 years going into the plan. Usually people are looking to do infinite banking because they need access to money relatively pretty quickly out of their policy. And the only way they're going to get access to money quickly is if you design the policy so that it's max funded. So I'm going to show you how we do that. So if we look down here, there's a couple numbers that really matter when it comes to infinite banking. First, the amount of life insurance, or what we call the initial death benefit. Then the 7-pay premium, which is the maximum amount of money that client can put into this policy every year in just the first 3 to 5 years, give or take their age and their health history. And then also their guideline level premium. That is the most amount of money that the client can put into the policy starting in like year 7 and on. So what you'll notice is in the beginning years, they can fund the policy at $45,594 a year. And then that's drastically going to get reduced down to $35,230 a year. Now, let's say that this client's goal was to save $45,000 a year for the first few years. If that was his plan, then this policy would be the absolute perfect size for infinite banking because the amount of life insurance that he's getting over here is allowing him to put in $45,000 in the first couple years. But let's say he maybe wanted to save $60,000 a year for the first couple years. Well, the first issue I would see here is this policy is way too tiny, right? How do we fix that? We would increase the amount of life insurance that he's getting. If you guys play around with your software, if you're agents, if you increase the death benefit, that's going to increase all the numbers that you see over here on the right-hand side, increasing the maximum amount of money he can contribute into his plan every year. But what if maybe he only wanted to put in $25,000 a year for the first couple years? Well, then this policy would just be too big for him, right? Because the maximum is $45,000 a year. He's putting in $25,000 a year. That is a $20,000 a year deficit, right? That means less money is going towards his savings and his index growth inside the policy, and more money is going towards the cost to own the policy, and that's not what we want. So how we would fix that is we would reduce the amount of life insurance that he got. That is going to reduce all the numbers that you see over here on the right-hand side, and you would want to reduce that to where the maximum, the 7-pay, matches that $25,000 a year, which is what that client's goal would be to save per year, right? But we're going to stick with this example. So let's say that this client's goal is to save $45,000 a year for the first few years of the policy being open and active, with the intent to borrow money out in the first 1, 2, or 3 years of the policy being opened. What you'll notice is, if you guys are agents, did you even hear me mention anything at all about the minimum premium? No, because most clients that are using these policies for infinite banking, they don't care what the minimum premium is, right? They don't care about that. They care about what the maximum premium is. They want to know what's the most I can save into this policy, not what's the least. So if you are a client, if you're somebody looking to be a client, and you are looking at these products and you're asking your agent what's the least amount I can save into the policy, you're not a good candidate yet for infinite banking. Infinite banking clients are asking what's the maximum I can save and how quickly can I save it, not what's the minimum. Okay, so this is just a different way to reframe how you're thinking. So this person is thinking what's the maximum. Now, before I dive in below, if you're an agent, another number that's important to point out is what we see here, which is target premium. Target premium is essentially what the agent is going to get paid for helping the client purchase this size of a policy. Now, a lot of times I've looked at IULs and the target premium equals the same number that the client wants to save per year. What that would mean is that this death benefit would be absolutely massive. So remember, the death benefit controls all these numbers. If this target number was at $45,000 a year, that would mean this death benefit would probably be at maybe $3 or $4 million, because that's going to increase this number. So agents get paid based on how much life insurance the client purchases. Now, if the client's goal is to use this for life insurance, well then, yes, you might want to have a higher target because their goal is also to have more life insurance. But if the client's goal is to have the least amount of life insurance possible because they want to use this for infinite banking, then you, my friend, are going to take a hit on your commission to do that and to make sure that the policy is properly structured. But it's important that you explain this to your clients, because they will then know that you properly structured the policy, that you took a hit on your commission. They don't necessarily need to know all the specifics about it, but they'll know that you are doing the right thing for them, and that's going to make them want to stay your client long-term and also send you more referrals. So don't worry about your commission that you're missing out on, because if your client is properly educated, they will be sending more people your way. So just had to clear the air on that. And again, the agents will get paid a percentage of whatever the target premium is. But again, that may seem like a lot to those of you that maybe are not working in the insurance industry, but in order to structure these, we have to have a lot of knowledge to know what we're doing, because we could really do some significant damage to your portfolio if we don't set these up correctly. So that's one reason why I think we get paid pretty well for what we do. And the best part is that commission doesn't come out of your pocket as the client, it comes out of the company's pocket. So whatever company we choose to recommend to our clients, they pay that commission to the agents, and the client just goes right into that policy without having to pay a dime towards commission, which is great. So if we shoot down here, you're going to kind of see how this works. So let me zoom out just a smidge so you guys can see all the categories. Okay, perfect. So let's just say, for example, this client, 35 years old, you're going to see over here on the left-hand side, it's going to say years, which is how many years the account has been opened. Age is how old we are in counting. That's the completion of the first year. He would be 36 years old. Premium is what he's saving every year. So let's say he's max funding this policy at the 7-pay, which is $45,594 a year. What you're going to notice is years 4 and 5 get really weird, right? That is because there is a maximum amount of money, guideline single premium, maximum amount of money that is allowed to be put into this policy in the first 5 to 7 years, depending on the client's age, and you cannot exceed it. If you were to exceed it, you would be creating what's called a MEC, which is a modified endowment contract, which means all the interest that you earn inside your policy will now be taxable, which is not what you want. So we have to follow the MEC or modified endowment contract guidelines, which means this software is automatically designed to do that. So it will not let the client continue to put in $45,000 a year, because we would be creating a MEC. And then what you'll notice is in year 6, right, it gets dropped down to the guideline level premium, which is the maximum that he can contribute in all years after the 7-pay, right? Which for this client, that would start in the 6th year, and so on and so forth. So this client could save the $45,000 in the first 3 years. You will see account value. This is how much cash is growing behind the life insurance. It is going to be the amount of money that he contributed minus the cost to own the policy, right? We do have a cost to the $750,000 in insurance, plus any interest that he earned. That is going to go here. Surrender charge is how much of his account value he does not have access to. So it's not necessarily a charge. It's just saying you have $43,000 in here. We are not giving you access to $14,000 of it. You do have access to $28,949 after that money has been in that account for at least 30 days, right? So there's a lot of insurance companies out there that don't allow you to touch your cash value for at least a year, some 2 years, some 3 years. I try to work with accounts, especially if we're doing infinite banking, companies that allow you to access your money after 30 days of the money being inside the account. And that is the one that we're looking at here. We can do that. And so then he would be able to take out a loan for a percentage of this. I always say you don't want to take the entire amount, maybe take 90, 95% of it at the most. In a loan, you always want to leave something in here. And then the death benefit is going to be that $750,000 that you see up here, plus the account value. So that's called an increasing death benefit. If he were to pass away, those numbers would get added together and that would pay out to his family all tax-free. You can also do a level death benefit where the account value does not get added to the death benefit. There's times both of those might make sense. I've got more videos on my page that dive into that a little bit further, but for the sake of this example, given that he's young, we will do an increasing death benefit. Now, for infinite banking purposes, we're going to be focusing on this surrender value category, right? This is how much money he has access to. This is how much he has, right? Account value is how much money he has. Surrender value is how much he has access to. So let's say year one, he wants to take out $25,000 to go put on the down payment on a rental property that he found out in Ohio, and he wants to do a fix and flip, right? So he would be able to borrow against this $25,000 and go take that money and go and put that into his real estate project. And then when he completes the project, come in and pay back off the loan. Now there's 2 loan types that you can do. I will link a video below that describes this in more detail. But if the insurance company that you're working with offers alternative or participating loans, he can basically borrow the insurance company's money instead of his own. So the insurance company would say, okay, you've got almost $29,000 in here. We're going to use that as collateral. We will loan you our $25,000. We will allow your $25,000 to stay inside this account growing and earning interest. And then when you have the ability to pay back off the loan, you can pay it back. Now they charge interest to do that. Most insurance companies charge somewhere between 5 to 5.5% interest to borrow the money. Usually it's simple interest, but if you're earning 7, 8, 9, 10% interest, you're paying 5, you're netting 3, 4, 5, 6% interest on money that really isn't yours and doesn't technically exist, right? So that's the concept of infinite banking. Let's look ahead maybe 3 years. Let's say he's got now $124,000 in here and he wants to take out $100,000. Maybe he wants to go buy some commercial property, right? He has the ability to do that. Again, the company will loan them the company's money, the insurance company's money. His money sits in here growing, earning interest. Now he still wouldn't have access to that $100,000 to take out on a second loan until it's paid back. He would only have $24,000 remaining on a new loan, but his account value would not get depleted. This is going to still grow and still earn him interest as though that $100,000 never left. So this is basically what you want to do when structuring these accounts. You want to make sure these things are max funded. Typically, my infinite bankers are not usually going to be funding these things forever, right? They're going to fund it for maybe 5 years or 10 years with the mindset to take money out, put money in, take money out, put money in. But the key is that if you are taking money out in the beginning of the policy, you want to make sure that you either A, don't deplete the account, or B, you're still putting something inside of there. Because this policy has a cost, right? There's a cost to this $750,000 in insurance, and you don't want to deplete it. I've had people ask me, oh, well, couldn't I just take my $124,000 in year 3 and run and not look back? No, it doesn't work like that, right? We don't want the policy to lapse or cancel, because if it does, any interest you earn is now going to be taxable. This is a permanent life insurance policy. It needs to stay in force throughout the course of your entire life. And how we do that is by being mindful on how we access the loans. I always recommend that you sit down with your licensed professional before you go taking any money out of your policy and make sure that you talk to them about the loan type that they would recommend you doing. But this is basically what these are designed for, to be able to earn interest in 2 places at one time. And again, this is all based on the size of the death benefit. So remember, the more life insurance you get, the more money you can put into the policy. The less life insurance you get, the less money you can put into the policy. If the client's goal is infinite banking, we want to get them the least amount of life insurance possible for the most amount of money that they want to be saving in the first couple years, right? If you're solving this on your side, you're running an illustration software solve, usually the solve is going to be called minimum non-MEC, which means least amount of life insurance for most amount of premium. And then from there, the software will help you figure out what's the amount of life insurance that you need to do that. Hopefully that's helpful. There is a lot to know when it comes to infinite banking. Like I said, I've linked a couple of videos below that will dive more into this topic. Today I wanted to show you the actual nuts and bolts on how to do it. The key is that you just understand the amount of life insurance dictates everything, and the more you get, the more money the client can put into the policy. The less life insurance, the less money the client can put in. So it's really crucial that these policies are set up and funded correctly, and that the client is asking you, what's the maximum amount of money I can save into my policy, not what's the minimum amount I can save. Now, for those of you that maybe can't save $10, $20, $30, $40, $50, $100,000 a year, well, guess what? You can start with a lower premium. You can start with something on a monthly basis and slowly work your way into that. And then maybe 5 or 10 years down the road, your policy could become something you can access in terms of infinite banking. It's just all about how quickly you can get money in so that it can start growing and compounding, and you can have access to it on loans, all tax-free. Now, again, this topic has been around for a very long time. IULs have become very popular in the space the last 20 years for infinite banking. So if you have questions about those products, they are linked below. I do always recommend before you do anything that you sit down and you consult with a licensed financial professional that actually understands this topic. I'm making this video because I have had multiple people ask me, do you know anything about infinite banking and how do I do it? Because I've been hearing about it and I want to do it. So hopefully this helps you figure that out. If you would like to work with me or my team and you live in the United States, we're happy to talk to you about this. All you have to do is click the link in my bio or in the description below. That will take you over to my calendar where you can book a complimentary client consultation with us. Please share this video with anyone you can think of that is looking into this concept. It's a fantastic strategy, but again, it's not good for everybody. There is approvals and other things that you need to consider, but please do share this with anyone else you can think of that can benefit from this concept. And if you like this video and you want to see more videos just like it, just click that subscribe button and hit the bell to turn on notifications, because I release a new video every single week. And if you want to see me back here next week, it's helpful if you subscribe. And it allows us to reach more clients and more agents to make sure people are designing and talking about these strategies the right way. As always, this is Amanda Riva signing off. Have a great week.